April 17, 1994, Wall Street. General Electric executives issue a brief press release that triggers an immediate panic across the financial sector. An internal investigation had uncovered a massive $350 million hole inside Peabody and Company, the historic investment firm they owned. The entire fortune was an administrative fiction manufactured by a single individual sitting at a computer terminal. His name was Joseph Jett. Over the previous 28 months, Jett had quietly transformed himself from an obscure, low-level analyst into the managing director of the firm's government bond desk. His recorded metrics defied market reality. By late 1993, Jett's trading desk was reporting over $120 million in annual revenue, single-handedly carrying the century-old brokerage firm out of a severe economic slump. The corporate hierarchy responded with absolute compliance. They rewarded Jett with a $9 million annual bonus and praised him internally as a financial prodigy who could read the government debt market better than anyone alive. But Jett was not outsmarting the market. He was not trading against other firms at all. Instead, he was exploiting a blind spot inside the automated tracking software that managed Wall Street accounts. While the digital screens displayed immense daily gains, the firm's physical bank vaults were quietly draining. To execute a multi-million-dollar deception from a single desk, Jett targeted a highly technical government security known as strips. Strips allow investors to separate a standard government treasury bond into independent pieces, trading the individual interest payments as standalone financial assets. Because processing these transactions manually was slow, Peabody linked its internal accounting software directly to the Federal Reserve's automated clearing system. Jett discovered a fundamental programming glitch in how these two systems exchanged data. When a trader enters a forward contract to merge separate strips back into a whole bond at a future date, the clearing system calculates the ultimate value of those assets. Jett noticed that Peabody's internal ledger software was coded to record these projected future values as immediate, realized profits on the exact day the order was typed in. The entire mechanism was a digital illusion. Jett would enter a massive forward contract to reconstitute strips, causing the corporate ledger to instantly credit his desk with millions of dollars in fictional revenue. To prevent the system from exposing the lie, Jett would enter a matching transaction to break the bond back down into strips just before the actual settlement date arrived. No capital ever moved. The software never checked the physical bank accounts to verify the cash. By manually entering and rolling over these circular phantom transactions every single day, Jett built a compounding tower of fake corporate wealth on a single line of unverified code. The illusion sustained itself for over 2 years because the corporate hierarchy refused to question a profitable anomaly. Every morning, senior management reviewed the firm's daily ledger performance. Jett's desk consistently showed vertical upward trajectories, masking the reality that the firm's actual government bond division was losing millions of dollars in real-world transaction fees. Internal compliance officers occasionally flagged the unprecedented scale of Jett's positions. His automated trades grew so massive that they routinely breached the firm's strict capital risk limits. However, because the automated software classified the forward contracts as risk-free government securities, the internal warnings were systematically overridden. Senior executives aggressively defended Jett against internal scrutiny. General Electric was preparing Peabody for a lucrative corporate restructuring, and Jett's phantom profits significantly inflated the firm's overall market value. Management was blind because the hierarchy wanted the numbers to be real. The architecture of the deception fractured in April 1994. A routine year-end capital audit forced compliance teams to cross-reference the firm's digital ledger records with its physical cash balances held at the Federal Reserve. The math did not reconcile. The computer screens showed hundreds of millions of dollars in profits, but the physical bank vaults held a massive deficit. The exposure of the ledger glitch resulted in the immediate, permanent destruction of a Wall Street institution. General Electric stripped Peabody of its leadership, firing the entire fixed income division. Facing absolute reputational ruin and a sudden $350 million asset write-down, General Electric sold the remaining pieces of the 129-year-old brokerage firm to Weber later that year, erasing Kidder, Peabody from existence. The Securities and Exchange Commission launched an aggressive, multi-year probe into Joseph Jett's isolated trading terminal. Jett refused to flee. He maintained his absolute innocence throughout the federal hearings, delivering a defiant defense. He argued that senior corporate executives fully understood his accounting methods and intentionally utilized his massive trading volumes to pad the company's books ahead of a sale. In 1998, an administrative judge ruled that Jett had single-handedly manipulated the internal accounting system. The court ordered him to forfeit $8.2 million in corporate bonuses and levied a $200,000 civil penalty. Yet the state cleared Jett of criminal fraud charges. The judge concluded that because the fake trades were internal administrative entries, they never deceived the general investing public. Joseph Jett never went to prison. The Kidder-Peabody manipulation proved that the most devastating threat to a modern financial empire is a single individual who understands a software system better than the executives who manage it. It left behind an enduring truth. If you control the baseline code of a system, you can manufacture reality right up until the moment the cash runs out.